Hi there. Today we've got Tom here from Drummond Capital to go through our quarterly update for you, our clients, in regards to what's been happening in markets. Welcome, Tom, and thanks again for joining us.
Thanks, Ellie. Good to be back.
Great to have you, as always. Today we're going to go through a short, sharp, punchy edition. And first of all, Tom, can you just give us a bit of an update on what's happened over the September quarter? There's, as always, been a few things that have happened in the portfolios.
Yeah, it was a interesting quarter from the context of events that happened. Some may recall the first week of August, we had a Japanese focused meltdown in at least Japanese equities, which affected all global equities more broadly, like Japan, as a result of its interest rate policy and changes there. Saw its stock market fall 25% in a few days and took world equities down 8. Later in September, we also saw a huge stimulus policy from China, similarly triggering large increases in the Chinese equity market, 25%. But good lessons in focusing on really what affects our global portfolios at large, developed markets, long-term trends, because over the quarter, sort of sticking to the strategy and maintaining saw portfolios up, 4 to 5%, delivering good returns, and a really good lesson, I think, for all investors just to stay on track.
Definitely. And there was a couple of other sort of changes over that time with interest rates as well in the September quarter.
Yeah, so we're starting to, and we can talk about this a little bit more, but US equities have really been leading the world, if you will. And so, but we are starting to see signs through July and again into August, where we saw the first interest rate cut come out of the US recently. In fact, most central banks have pivoted toward rate cuts as inflation's become closer to target, and that has helped other parts of the market perform well, or other markets in general. Like last year, it was all about the big tech stocks, and then this year we've seen it broaden into other sectors of the economy, other markets like Asia. Australia started to play some catch up, and so we've just made some adjustments within portfolios to capture a little bit more breadth and overall that's a good sign for the health of the outlook for markets and portfolios at large. You don't want returns to be concentrated in just a handful of individual companies. You want to see broad participation, and we're starting to see that as rate cuts come through.
Yeah, it was great to see, and I know you touched on the Aussie markets and where they're at, but I guess to move forward, thinking about what clients are asking me every day, it's where are we at in markets? Are we at the peak of where we are at in this cycle now? Can you speak to that at all, Tom?
So valuations in the US and Australia are now quite elevated versus history. So the US is at, say, 22 times P versus an average of, say, 16. So it's quite a bit more expensive. Australia is similar, sort of 2021 versus 15. And so really having increased in their valuation, you would be concerned around peak in the cycle if we were peak economy and in going into recession. That's usually what triggers a big fall in equity markets. But the economy is growing, strongly. US GDP growth north of 3. Australia is a little sluggish, but in general, we're seeing a pickup in global growth, not a decline in global growth. So no recession at this time. And if inflation can remain under control and those rate cuts come through, then the outlook for the economy next year is reasonable, about long-term trends, sort of 2 to 3% GDP growth. So in that environment, equity markets should be okay. But having risen strongly and become a little bit expensive, the driver for future returns needs to be about earnings. And so we are looking, more broadly to see where we're getting better earnings growth coming through. And to that extent, Australia actually looks a little bit challenged. So this Aussie market at large hasn't actually delivered any earnings growth this year. And similarly, next year looks like it's not going to deliver a lot either. Whereas in the US, they've got much, with it particularly driven by tech, but also more broadly, much stronger earnings growth, and that's likely to be the driver for next year.
So in terms of how portfolios are positioned with Drummond at the moment, is that reflective of still maintaining a lot of exposure to those markets?
Yeah, so US and global equities are still the largest exposure of portfolios, and within that, US equities, we did pull back a little bit. They have run pretty hard, and they, as we said, are more fully valued. And so overall risk settings, we're neutral. So we're sitting at a neutral asset allocation. We're not overweight or underweight. But the biggest exposure within that is still global equities, and in particular the US.
Yeah, so positive signs for the future. One of the other biggest questions that I get from clients and barbecue chat is what's going to be the impact of the US election and a lot of other geopolitical events that are happening around the world on markets? What's your perspective?
So the US election, firstly, it's really hard to position for uncertain outcomes. So it's, as an investor, unless there was a really obvious outcome and policy setting that you could see in advance, it's hard to sort of say, oh, we should adjust our portfolio today based on, Donald Trump being elected or Kamala Harris being elected. The markets are starting to price a Trump victory, so bonds are selling off. Interest rate, are rising a little bit because he's likely to have higher inflation policy. So tariffs and tax cuts are broadly inflationary, and so the bond market has reacted a little bit to that as the polls have shifted in his favour. But it's sort of at the margin. If he doesn't win, that can reverse quite quickly. And look, the reality is both of them are big spenders. So there's no one sort of coming in and changing the current trajectory of fiscal spending, which has been a continued driver of growth and somewhat inflation as well. And so under both administrations, that's likely to continue. So I guess from a market's perspective, not too big an impact. I'd expect to see, like previous elections, sort of quite a bit of volatility maybe in the days leading up or just after, but that's okay. That's noise. It's a little bit like the Japan piece. It won't be as extreme as that, but in terms of a bit of volatility around the result, and then the market will look through it as it has in previous episodes. But the other geopolitical issues, mainly emanating out of Ukraine and Russia and the Middle East. From a markets perspective, it's all about the oil price and commodity prices more broadly. The oil price has fallen this morning based on Israel not attacking Iranian oil facilities over the weekend. It has been pretty well contained. So the best barometer for whether geopolitical issues in those regions are going to impact markets more broadly is just to look at the oil price. If it's running from 70s like it is now, fast to 100 and through, as it did when the Ukraine war broke out originally, that's when you get worried about the broader impact on the economy and markets. But at the moment, it's contained. So from an investing perspective, we don't think there's anything to worry about just now.
But it sounds like, Tom, a lot of noise around at the moment. And again, key to and a pillar to investment philosophy is really separating that noise from strategy, by the sounds of it, from your perspective.
Absolutely.
Yeah, definitely the message for our clients too. Well, again, Tom, really appreciate you giving us your perspectives, and I'm sure plenty of our clients are going to enjoy it too. And unless there's anything crazy happening in the next couple of months, we'll see all of our clients again in the new year.
Sounds good. Thanks for having me, Ellie.
Thank you, Tom.